Yo, what's up, everybody? Welcome to the most unexpected, thrilling, and downright wild ride you'll ever experience in the world of finance. Trevor Noah here, ready to break down a topic that's usually about as exciting as watching paint dry Forex or foreign exchange. But trust me, today, we're going to make it as exhilarating as a roller coaster ride. But hold up, because we're spicing things up today by throwing geopolitics into the mix. That's right, we're talking about how global events can turn the Forex market upside down. Think of Forex as this massive global party where currencies get traded 24/7. It's a non-stop, high-energy event where every second counts. It's like the world's biggest casino, but instead of poker chips, we're talking euros, dollars, yen, you name it. Every currency has its own value, and that value can change in the blink of an eye. Now imagine a bunch of unexpected guests crashing this party like, say, a trade war or a global pandemic. That's geopolitics, folks. These events can throw a wrench in the works and create chaos. These events can send shockwaves through the Forex market, making currencies do the jitterbug like nobody's business. One moment, everything's stable, and the next, it's complete pandemonium. Suddenly, your euro might be worth a whole lot less, or your dollar could be riding high. These fluctuations can have a massive impact on economies and individual fortunes alike. It's a wild ride, and understanding how it all works can be the difference between making bank and, well, losing your shirt. So, buckle up, Buttercup. We're about to take you on a journey through the highs and lows of the Forex market. We're about to dive into some real-life examples of how geopolitical events have shaken up the Forex market, leaving everyone from Wall Street bigwigs to your average Joe scratching their heads. From Brexit to trade wars, these events have left a lasting impact. Let's get this party started. Get ready to explore the fascinating world of Forex and geopolitics and see how these forces collide to create a truly wild ride. Stay tuned, because you won't want to miss a second of this. First up on our geopolitical greatest hits list, Brexit. A moment in history that left the world both shocked and intrigued. Remember that time when the UK decided to ghost the European Union like it was an awkward Tinder date? Yeah, good times. Social media was ablaze with memes and jokes, capturing the collective bewilderment and humor of the situation. Back in 2016, the UK held a referendum, basically asking its citizens, EU in or EU out. The debate was fierce, with passionate arguments on both sides. Campaigns were in full swing and the nation was divided. The Leave campaign pulled off a surprise victory, sending shockwaves through, you guessed it, the Forex market. Traders and analysts were caught off guard, scrambling to make sense of the new reality. See, the pound sterling, the UK's currency, is a bit of a diva. It thrives on stability and predictability, much like a seasoned performer who needs everything just right before stepping on stage. It likes stability, predictability, and a good cup of tea. The quintessential British experience, calm and composed. Brexit, not exactly its cup of tea. The uncertainty and upheaval were the antithesis of what the pound needed. As soon as the results came in, the pound took a nosedive, dropping to its lowest level against the US dollar in over 30 years. It was a dramatic fall, akin to a roller coaster plunging into the abyss. It was like watching a financial horror movie, except it was all too real. The screens were filled with red and the atmosphere was tense. Investors were freaking out, businesses were scrambling, trying to mitigate the impact and figure out their next moves, and everyone was wondering what the heck was going to happen next. The future seemed uncertain and the stakes were incredibly high.
The Brexit referendum was a seismic event in the geopolitical landscape. It was a decision that would reshape the UK's future and its place in the world. It not only altered the UK's relationship with the EU, but also had significant ramifications for the global economy. The ripple effects were felt far and wide, but also had significant ramifications for the global economy. The uncertainty surrounding the negotiations and the future trade agreements created a volatile environment, making the Forex market particularly sensitive to any news or developments related to Brexit. The uncertainty surrounding the negotiations and the future trade agreements created a volatile environment, making the Forex market particularly sensitive to any news or developments related to Brexit. Every headline, every statement from officials had the potential to move markets, making the Forex market particularly sensitive to any news or developments related to Brexit. Investors had to stay on their toes, constantly monitoring the situation. Investors had to navigate this uncertainty, often reacting swiftly to any updates, which contributed to the pound's dramatic fluctuations. It was a time of high stakes and high stress, which contributed to the pound's dramatic fluctuations. The charts told a story of volatility, with sharp peaks and troughs reflecting the market's anxiety and anticipation.
Next up, we've got the US-China trade war, a real nail-biter that had everyone on edge. This wasn't just a minor skirmish, it was a full-scale economic showdown that had the entire world watching with bated breath. Picture this: two economic superpowers, locked in a battle of tariffs, sanctions, and enough economic jargon to make your head spin. The stakes were incredibly high, with both nations vying for economic dominance and neither willing to back down. It all started in 2018 when the Trump administration decided to slap tariffs on billions of dollars worth of Chinese goods, claiming unfair trade practices. This move was seen as an attempt to level the playing field, but it quickly escalated into something much bigger. China, not one to back down from a challenge, retaliated with tariffs of its own. The tit-for-tat measures created a cycle of retaliation that seemed to have no end in sight. The result? A full-blown trade war that sent shockwaves through global markets, including, you guessed it, Forex. Investors and traders were on high alert, trying to navigate the turbulent waters of this economic conflict. The Chinese yuan took a hit, weakening against the US dollar. This devaluation was a strategic move by China to make its exports cheaper and more competitive on the global stage. It was like a game of currency tug-of-war, with each side trying to weaken the other's currency to gain an advantage. This constant back and forth created a highly volatile environment in the Forex market. This back and forth had businesses and investors sweating bullets. Companies were unsure about future costs and supply chains, while investors were trying to predict the next move in an increasingly unpredictable market. The uncertainty was like trying to predict the weather in a hurricane. Good luck with that. Every new announcement or policy change was like a gust of wind, throwing markets into disarray.
The US-China trade war exemplified how geopolitical conflicts can have far-reaching impacts on global markets. It wasn't just about tariffs. It was about the broader implications for international trade and economic stability. Each round of tariffs and counter-tariffs introduced new layers of uncertainty, making it challenging for businesses to plan and for investors to make informed decisions. The ripple effects were felt across various sectors, from manufacturing to technology. The Forex market was particularly reactive, with the yuan and the dollar fluctuating based on the latest developments. Traders had to stay on their toes, constantly adjusting their strategies to keep up with the rapid changes. This period highlighted the interconnectedness of the global economy and how actions taken by major powers can ripple through financial markets worldwide. It was a stark reminder that in our globalized world, no economy operates in isolation. As the trade war dragged on, economists and policymakers began to discuss the long-term implications. Would this conflict lead to a new era of protectionism, or would it force countries to come together and negotiate better trade agreements? Despite the challenges, there was a sense of hope that this turbulent period could lead to more balanced and fair trade practices in the future. Investors and business leaders were cautiously optimistic, looking for signs of resolution and stability. In the end, the US-China trade war served as a powerful lesson in the complexities of global trade and the importance of international cooperation. While the road to resolution was rocky, it underscored the need for dialogue and collaboration in navigating the intricacies of the global economy.
Section 4. The Russia-Ukraine conflict, sending shockwaves. Hold on tight, because our next geopolitical roller coaster ride takes us to Eastern Europe, where the Russia-Ukraine conflict sent shockwaves across the globe. In 2022, Russia launched a full-scale invasion of Ukraine, throwing the world into a state of uncertainty and fear. This wasn't just a regional conflict, it was a geopolitical earthquake with aftershocks felt across every market imaginable, especially Forex.
The Russian ruble, already facing pressure from Western sanctions, went into freefall, losing a significant chunk of its value against major currencies like the US dollar and the euro. It was like watching a currency skydive without a parachute.
But the impact didn't stop there. The euro, already grappling with the energy crisis exacerbated by the conflict, also felt the heat. The uncertainty and potential economic fallout from the war sent investors fleeing for safer havens, putting downward pressure on the euro. But the impact didn't stop there. The euro, already grappling with the energy crisis exacerbated by the conflict, also felt the heat.
The uncertainty and potential economic fallout from the war sent investors fleeing for safer havens, putting downward pressure on the euro.
The uncertainty and potential economic fallout from the war sent investors fleeing for safer havens, putting downward pressure on the euro.